Hey, everybody, and welcome to the Everyday Investor. In this episode, we are going to be talking about one of the sectors or areas that we can invest in that could provide a rate of return which is higher than the average return that we'll get simply by investing in the entire market all at once. I'll underline the word could, though. If you're coming into this episode and you're just starting out, or you've never really understood how investing in green companies can produce a literal green result, the theory is, the best I can explain it, is that by investing in companies that attempt to improve the climate, you're helping to increase the size of capital or the amount of money these companies can access for growth. If you can decrease the cost that these companies incur, you can make them more profitable. In other words, you can encourage them to keep on doing more of their activity. Going further, if we speculate that the cost of capital for companies that don't change, we'll call them the brown companies, well, their cost of capital is now growing relative to everyone else. At the big money part of town, this plays out when fund managers apply a negative screen over the companies that fund invests in. Less money will then flow to the businesses that cause harm to the planet, and more money flows to the ones that are doing good. Over time, what we're basically doing here is that we're starving off the bad activities and we're feeding the good activities. But for those of you who are a little bit skeptical, not necessarily around whether or not climate change comes from human activity, but if you're skeptical that investing in green can actually change the climate, I have a different message for you. Before I go there, though, I need to talk with the greenies, though, just a little bit more, just to explain why some are a little bit skeptical or even a bit cynical. Some people fear the climate crisis is nothing but a Trojan horse full of communists waiting to jump out and redistribute their wealth and take away their personal freedoms too. Blaming capitalism or corporate greed for climate change, then, is a great way to reinforce that thinking. If you're looking for a source of blame, after the introduction, I'm going to suggest one to you shortly that's probably a lot more accurate. And my hope here in pointing this out to you is that you'll win more of the population over to your way of thinking. So again, back to the skeptics. Let's just say that climate changes on its own, irrespective of man-made pollution. Let's also say that no amount of change in human behavior, including a depopulation strategy, will ever change the rate of increase in the average temperature over time. Here's why it doesn't matter what you think about this space if you're coming at it from an investor's perspective. In the notes is a link to a McKinsey report, and I'll read a couple of sentences from it right now. Climate technology is getting a further boost from unprecedented government programs in the United States and Europe that will unleash a flood of capital to meet the challenge of achieving net zero emission commitments by 2050. Together, these measures may open up more opportunities for investors in a market that could reach $9 to $12 trillion a year by 2030. So think of the value of Apple, Amazon, Microsoft, Nvidia, Google, Tesla, and Berkshire Hathaway all rolled up into one. That's the amount that will soon flood into this space each and every year. So consider what happens when the whole world goes down that path. Unfortunately, there have been agendas, though, and terrible attempts to use a climate crisis as cover to introduce all sorts of initiatives that rub people the wrong way. But that doesn't change the fact that there's still a tremendous opportunity here. Now, it's a weird bit of game theory, but if you start to invest according to some sort of green framework, you are joining forces not just with a world of other investors doing the same, but also with government initiatives from all over the world. All this money will lower the cost of capital from the startups all the way to the largest companies in the world. Yes, this is a potential recipe for disaster from an inflationary point of view, but that's another story. The point is, this could be a way to get the higher returns that you're going to need for this future. In other words, what I'm saying is this: when you invest in the climate, you can choose the penguins or the Benjamins or a bit of both. There's a wall of new money pouring into the green sector, so this could be one of the largest macro tailwinds that everyday investors could ride. You're listening into the Everyday Investor Podcast. Passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow the Everyday Investor on all social media channels. The NZ Everyday Investor Podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial Advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started. Now, before we start on the main event today, I'd like to answer a question around who caused the climate crisis and what likely needs to be done before we can really start to solve the problem. Skip ahead if you like by 10 minutes if you don't want to listen to this opinion, but after this little bit, I'll be sharing a discussion I set in on recently as part of the Auckland Climate Festival. Apart from me, you'll hear from Shannon Barnes, a research analyst for Mindful Money, Rowan McMahon, the co-founder of the Climate Venture Capital Fund, and Vincent Huringa, the host of This Climate Business podcast. So, who caused the climate crisis and what can we do about it? First, a couple of conspiracy theories on both ends of the spectrum, just to ensure that I've offended all of you as equally as I can. I've heard from very smart people that it's actually corporate greed that caused the climate crisis. The greedy, rich people also cause inequality, and therefore, the more taken from that space of society and given to the other side of society and to the problems that we have on planet Earth, the better. As long as it's people with a lot more money than you have, that's probably what you think. Now, equally smart people on the other side of the spectrum say that man-made climate change isn't even a thing. In fact, the climate crisis is nothing but a Trojan horse full of communists waiting to jump out and make us share stuff with our neighbors, or worse, take all our stuff away and make us eat bugs. Now that's perhaps a little bit wacky and too simplistic of a description of some of the viewpoints that we get suckered into around the topic of climate change, and it really makes it hard, I think, to see this space for what it actually is, which is potentially a risk and potentially an opportunity. So, if you can permit me to do so, I would like to suggest that overconsumption and the excess pursuit of profit, which are both expressions of greed, have caused harm to vulnerable people and the environment. Now, more than that, though, I want you to consider why we're driven to overconsume and why we're driven to pursue profit so aggressively. But we can't go on down that path of explaining that without first talking about money. Going way back to the early 70s, governments and banks figured out that if you separate currency from money, you can induce a rate of consumption which can increase gross domestic product, or GDP, allowing for more growth and more revenue in taxation as a result. How do you induce consumption? Well, you get more money into the hands of people who feel like they need to consume fast. Here's the challenge, though. It's impossible to create money out of nothing, especially if we define money as something with intrinsic value, like gold, for example. The way to get more money into the system, then, is to swap what we call money for something which is fiat currency. That's what we have today, which is basically legislated money. When we or our governments access this money or credit through borrowing, new currency comes into existence that wasn't there before. There's more money in circulation.
This is why it's true that credit creation can be said to be a source of inflation. Inflation makes it rational to consume more today than consume tomorrow, and it forces us to earn more and more money in the future to offset the effects of this invisible thief. Although presently it's much higher, let's say we have a 2% rate of inflation every year. Here's what this means for you. It means that a $100,000 bank account actually buys only $50,000 worth of stuff in 30 years' time. So from the age of 35 to 65, unless you've doubled your net worth, you're actually going backwards. So let me ask you a question. If you knew that you would lose half of what you own today, what would you do about it? I don't know about what you would do for sure, but you may choose to spend more of that money today, knowing that you're going to be losing half of it. And you may also start to try and figure out ways that you can make more money with the money that you already have for future use. When we observe prices are rising all around us, it forces us to purchase the things that we need a lot sooner than what we normally would. We're bringing consumption from the future into the present through the act of borrowing and spending faster. Now, in some cases, we may choose to consume far more as a result of this too, far more than what we need. When it's easy and cheap to borrow money, we bid up the price of items that we need and items that we choose to invest in as well. So apart from consuming more, we're also incentivized to figure out ways to make more money. We work harder and we take more risks to make money. We forego consumption and we invest, right? So we invest in things that pay bits of money back to us over time. And hopefully a lot of money gets paid back to us in the future when we sell the thing that we put the money into. If we do the job of investing well, we can maintain and improve our standard of living, and we can offset the impact of losing purchasing power over time. So you're not greedy when you invest, you're just preparing for a more expensive future. Now, over the last few years, you might think, well, what's the big deal with inflation? In fact, apart from maybe the last 2 years, you might not even have known what inflation even was. But how is inflation and climate change linked together? Inflation causes us to do three main things, which I think are as linked to all sorts of evil, including potentially climate change as well. Firstly, it causes us to make more money because even at just a 2% inflation rate, the same amount in your bank account is worth half as much in 30 years' time. To make more money, we need to work harder and we need to take more risk. Secondly, high inflation incentivizes us to overconsume, which is unsustainable in the long term. And if we can't earn more to offset inflation, the only other rational choice is to consume even more today than what we ought to. And given much of what we consume burns oil to get made and leaves plastic behind when we're done with it, the more we consume, the more demand there is for things that may cause harm for the planet. Thirdly, inflation causes us to invest in businesses that are good at growing their revenue faster than their expenses. Sounds like a bad thing, but it's a good thing, but it's also a bad thing. It pressures firms to make decisions that can optimize for profit over people or over the planet. And now we're getting closer to the true cause of overconsumption and the pursuit of profit. It's our financial system itself. A fiat currency system is programmed to expand at all times. The supply of money has to grow over time. If there's no new net credit creation, which causes the positive inflation in our money supply over time, we potentially tip into a depressionary death spiral. Doesn't sound like a happy place. So over the years, we've learned how to live under a system that works like this. We've been conditioned to consume and to strive for more. And under this system, governments do less with more of our money, and assets accrue more to those most able to access credit. Now, investing in green companies, though, isn't just a moral choice, it's a strategic one. You're steering your capital towards sectors that are poised to benefit from a surge of money coming into this place from fund managers and government initiatives in the future. Even if you're determined to invest in a way that cures the planet, just keep this in mind. To fix the world, we need to first fix the money. Now, I'll finish up with this thought. Hating the rich is no way to help the poor, and saving the climate should be to save the people. That's it for me, but let's get started on today's show. Hope you enjoy.
The purpose of this discussion really is to talk about what's the role that climate is having on finance and investment, but also what role can our finance and personal choices around finance have an impact on climate. We thought we would gather three very knowledgeable people together because it's a complex subject, but thankfully we have three experts to guide us through. And so without further ado, thanks for joining us. But Rowan, give us a quick summary of who you are and what's your connection into climate finance.
Thanks very much, Vincent. Ngā mihi nui kia koutou. Great to be here. So I'm a partner in the Climate Venture Capital Fund, which is New Zealand's only climate tech investment fund. Our job is to invest in early stage technologies and companies that can decarbonise the planet. So every company that we invest in is doing something transformative to reduce emissions in a very provable and measurable way. That's our contribution to helping to address the climate crisis. And we also believe that because we see the transition to a cleaner economy as being inevitable, we believe that that will create great commercial returns over time for our investors.
Shannon, who are you? What do you do?
Kia ora tātou. Ko Shannon Toka Ingoa. So I come from the environmental sector. So I've worked in environmental and ecological consulting and then in regulatory compliance. And through those roles, I kind of witnessed firsthand some really great examples of really good environmental restoration and kind of climate adaptation on the ground, but then also some really bad examples of environmental pollution and polluters getting away with things that didn't necessarily do good things with the climate. And so I kind of got questioning, like, what are the underlying mechanisms that support the things doing good and de-incentivize the bad guys from causing harm. And underlying that all is pretty much money. Like, money has a lot of power to influence those things. So kind of overnight I went and looked into this climate and finance and investing stuff and thought, kind of, how complex can it be? Turns out it's pretty complex, and I'm still learning today. And so I now work for Mindful Money. So we are a charity that brings in transparency to what's in KiwiSaver and managed funds in New Zealand in terms of the harm and the good. And so we have a platform. It's free online for anyone to go and look at. You can type in any KiwiSaver fund you want, and it'll bring up what it's invested in terms of issues of concern or harm. And then you can choose to switch to a more ethical fund that aligns with your values. Yeah.
And not just KiwiSaver, right? You're also applying that to managed funds.
Yeah, managed funds as well.
Yeah. My daughter used it actually to choose
cool.
her first KiwiSaver fund. She used Mindful Money to go through and exclude what she was, wanting to exclude and also, I guess, highlight the things she wanted to invest in. So, great tool. Thank you.
User-friendly tool, yeah.
Yeah. Darcy.
Yes, hello, Vincent. How are you?
Well, fantastic. It's a gorgeous day here in Auckland. Tell us about your NZ Everyday Investor and also your connection into climate.
Sure. So, hello. I am Darcy Ungaro. I'm a financial advisor. So I work primarily with everyday people trying to make everyday money moves, moving house, dealing with property and mortgages. But then I have an interest in helping self-directed DIY investors make better money moves. And I'm quite interested in the space in between, like the tension between extremes. And in terms of like the intersection between technology that's changing geopolitics, and this climate opportunity, I would call it. I've kind of starting to see now that there's a lot of dynamism for everyday investors going forward. So the podcast is really about me exercising those thoughts and engaging with people from all sorts of diverse headspaces and industries to try to find a common thread or like a trail of breadcrumbs that those that are still trying to develop wealth can follow. And that keeps me very busy. That's all I can say.
And a great excuse to talk to people.
Oh, it's amazing.
Yeah. So climate change is many things, but it's basically a disruption to the natural world. And disruptions are an opportunity for making money and losing money. We've seen it before, whether it's in tech or whether it's geopolitics. But, it has its own unique elements to it. Rowan, do you want to, could I ask you to describe how is climate change disrupting business as usual for us?
we're in a fossil fuel economy. The global economy is driven by fossil fuels. This glass of water, the water was brought to us using fossil fuels. The glass was made with fossil fuels. Everything around us is produced with energy, and most of the world's energy comes from fossil fuels. That started with the Industrial Revolution, really. We've invented mass customization, mass consumerization of products. We've invented things that have brought us amazing utility as consumers. We can have washing machines and iPhones and world travel and so on. But all of those things come with greenhouse gas emissions, which was something that we never thought to price. And when those of us who went to business school or economics school were taught that pollution was an externality that had no cost. But it does have a cost. The cost is up there, and we're now starting to recognise that cost, and it's falling in different ways in different places, but it is falling in a profound way, which is more and more visible every day. The disruption is the process of us realising that cost and recognising how it's going to land and moving to something different and better. So the way in which we see it is that because responding to climate change is an existential thing that the species has got to get on with and is getting on with, that requires us to unpick all of those fossil fuel economy linkages that we've built up since the Industrial Revolution started. So it means we have to decarbonise, coal-fired power stations, which is kind of obvious, but it also means I've got to decarbonise this glass of water, which is not so obvious. You've actually got to think about the entire economy. And so what we believe is that there are profound opportunities to be realised by people who do the homework to decarbonise the easier things, and which might be the more expensive things, but also to decarbonise the harder things, the things where we haven't found easy solutions yet. And so I'm not one of those people who believes that technology is a magic solution to everything, but it definitely provides solutions to a lot of things. And we invest in trying to help some of those businesses get to scale.
The disruption that you've just talked about is swapping out technology, shifting to a different kind of economy. Shannon, we've seen another disruption with these storms all around the world. Every week there seems to be another storm, and we experienced some wicked storms here in New Zealand, in January.
Yeah, and it creates disruptions to not only like there and now when the storm happened and everyone was kind of displaced, but the ongoing thing. So you look at, all the industries in the east coast of the North Island, so the horticulture and farming, that drew up prices in our supermarkets based on like the food supply. And so it's like trickle down stuff that goes throughout the country, throughout the world. It's not just where it's happening there and then.
Yeah. And a little bit like COVID in the way that, logistics were, COVID's not necessarily a climate-related disruption, but the blocking of roads, the breaking of bridges, suddenly access around the motu is limited, right? And that's another example of the kind of disruptive change that we are going to be expecting.
Yeah, for sure. And we're only kind of now in the mainstream starting to realise that climate change is linked to biodiversity loss, it's linked to human rights. So all these other issues are all interlinked, and so we can't just address climate change itself in isolation. We need to be thinking about the wider picture. So, there's negatives and like a very few positives that come out of it. But one of the positives is that we have to like rethink our thinking into more bigger picture, holistic things to solve these really complex challenges.
We've been here before, though, Darcy. I mean, we've experienced disruptions. There have been wars. There's been COVID pandemic. I'm just thinking of the tech wreck, there was the tech boom and the tech. So disruption is not unusual for investors. When you've witnessed and experienced these kind of big systemic changes, what happens for investors? What should they be thinking about?
What should happen, or what investors should be thinking about, is obviously long-term rather than the short-term noise, because there's always going to be short-term noise and events that shake people to their core. But number one, I would say you have to maintain a long-term focus and understand some of these macro trends, which are often scary and disturbing to consider,
right?
Like what we're talking about today.
Yeah.
So thinking long-term, ideally within a base case of optimism and an overlay of pessimism rather than the other way around, and diversification, right? So I think investing in green investments, to use a pretty basic term, is a really great portfolio diversifier, because you're benefiting if, I guess, degradation in the climate which is beyond what the market is priced into these investments. And so even just as a hedging strategy, that kind of makes a lot of sense to me. There's also maybe even thinking about more extreme hedging tools. So in other words, things that go up in value much more significantly during times of crisis/opportunity. And again, I would probably think of the startup ecosystem as a really good example of that, and with sort of mainstream alternative assets, specifically Bitcoin, and kind of really digging in deep around some of the myths around its damage to the environment, and actually seeing what kind of opportunities exist there, which I think there are some tremendous opportunities. So I think, yeah, keeping an open mind, looking at some scary stuff, diversification and hedging, those would be the things I would point at.
You think about something like EVs as the Tesla stock just goes up and up and up, and it's driven off the back of this decarbonisation trend, right? So would that imply, looking at with your kind of hedging strategy, would that imply that you go kind of long on Tesla, for instance? This is not advice, by the way. Do we have to say that?
Yeah, I think we probably should.
Right. Okay. Let's say you go long on something like Tesla, and you go short on something like a GM. Or
I think even before you get into that, you probably want to consider what the reason is why you're investing. Are you investing for a return? Are you investing exclusively to do good? Ideally, you're going to do both, right? And that's kind of like what you're trying to achieve is the balance between both those. There's going to be probably more opportunity for the brown industries turning green in some instances, and the other way around. It just depends on what level of degradation to the climate actually occurs over time versus what we think or what the market thinks. And if you try and outsmart the market, you're going to get your face ripped off. So you don't want to short
I thought
Tesla.
That's the whole point of being an investor, is you're going to be smarter than the other guy.
Well, yeah, you are, but I think it defaults to design rather than unction. You can't just trust your gut feel in these situations or even trust the marketing spiel. You have to be quite strategic, and that's where I think thinking about how your portfolio is constructed and allocating things towards mainstream investments with slight tilts rather than going all in on these speculative bets is really the way to do it.
Right. Okay. So that was kind of having a portfolio approach.
Correct.
Yeah.
Absolutely.
Yeah. Okay. Well, that's always good advice, isn't it? Have a portfolio. The other lens that you could look at this is start to use ethical criteria for making investment decisions, right? And I know at Mindful Money, and I suspect Rowan too, you would argue that having an ethical lens would actually help you identify longer-term successful bets. Do you want to just expand on that? I mean, do you agree with that idea?
I mean, it's one method to do it. It's not the be-all and end-all, but ethical screening, in essence, is putting a ethical or sustainability criteria and screening out the harmful things that you don't want and then keeping in the things you don't mind. And so it's a really great tool to reduce your exposure to the risks of those harmful things that you want to keep out, while also making your portfolio align with your values. And so that's kind of the essence of Mindful Money, as we have that website and you can go on and we have a fund checker. And so in the fund checker, the fund finder, you can go on and screen out the things that you don't want and then keep the things you don't mind in. So you might be someone that really cares about climate change, so you don't want fossil fuels in your investments, but you don't mind alcohol or other things like that. So you keep those in, and then it'll spit out a few different options of funds that you could potentially align with your values or switch to if you wanted to. And so it's a really great tool for like the everyday Joe Blogs personal finance investor that just has a KiwiSaver, because for an average person to be putting their money away in KiwiSaver every single week, there's no way they're going to know where that money's actually going to unless you go to your fund provider and say, can you provide me with a full list of companies? And then even then you've got the list of companies, but how do you know if those companies are doing harm or doing good? So it's really Mindful Money is just a platform for transparency, so we take that hard work out for you.
Yeah.
So it's one tool to use, but it's not the be all and end all.
But I suspect that I think the argument that Mindful Money would make, and I reckon Rowan too would make, that not only is this a tool for aligning with your values, but actually a values-based decision will deliver a better financial result. Would you go that far, Rowan?
Absolutely. Over time, we have, obviously being a climate fund, we only invest in emissions reduction. So if you can't satisfy us on that, then the rest of it is kind of irrelevant. but we also have a pretty strong set of ESG policy settings around exclusions of things that we think have negative consequences for human rights and labour rights and so on and so on, alcohol and tobacco and the like. I think that we certainly see that those things over time will give us a portfolio of companies that we've invested in that aligns with our values personally, probably aligns with the values of the people who've invested in us, but you'd have to ask them. But over time actually will produce really great returns as well, because intrinsically what the products and services that these companies are building are cleaner, greener, socially acceptable products. Therefore, they'll find markets. I mean, it's funny how, I've spent a lot of my background working in the technology sector, and we used to talk about faster, cheaper, better. But to me now, it's faster, cheaper, better, and lower emissions. So if you're making a product or a service that is inherently faster, cheaper, better, lower emissions than the competitors, it will tend to sell. The lower emissions part is in the title of our fund, but those other attributes are important as well. And we think that there are a lot of investors who are very motivated around that. I'm certainly motivated around that personally. It just see no reason to be investing in things that I'm not comfortable investing in. That seems pretty obvious, doesn't it?
I guess that's obvious at an individual level. Darcy, do you buy the argument that, say, for instance, not just looking generally at ethical investing, but specifically climate, is a lower emissions criteria going to be an important kind of yardstick to include in your, for financial returns? Is that going to be part of the mix?
Depends on what perspective we're coming from. Like if we're coming from the perspective of the everyday investor, when push comes to shove, if there's a risk that you're not going to get the return that you could get elsewhere, you're probably still not going to do it. That's kind of where we're at right now. So I think we'd all like to think of ourselves as ethical investors and that we don't want to be doing all these things. But in reality, we probably want a rate of return. And so I kind of always think of the perspective of the everyday investor looking at the climate opportunity is not yet there. You know what I mean? Like it's so thick with greenwashing probably coming down from the large fund managers that it's really hard for them to separate the wheat from the chaff and to actually understand what's real and what's just noise. And so that probably doesn't answer your question.
No, but it's such an interesting kind of spoiler, isn't it? That even if you think that there's a logical connection between lower emissions and a more sustainable, successful business, how then do you discern which is the truth from the greenwash?
Or even, does it even matter? Because like I've been reading some reports over just last weekend around just the amount of money that's going to be coming into this space over the next few decades is phenomenal. So does it really matter if it's real or fake or greenwashed or not? It probably doesn't, right?
From a purely kind of market return point of view,
totally.
It probably matters from a planetary point of view. But is it? I suppose that's what the tool is for, right?
Yeah, and the tool comes down to how legitimate that screen is. So funds can easily put a exclusion criteria on and say, I want to exclude fossil fuels. But then it gets quite complex because they might hold a fund that holds another fund that holds another fund, and there might be a fossil fuel company way down the track. And at Mindful Money, we account for all of that. So we look into like every single kind of down the chain investment that funds have. So it does get picked up for us, and we have quite a clear methodology we follow as well to what constitutes our criteria.
Rowan, how do you discern the wheat from the chaff when it comes to investment decisions? Like, how do you know you're not getting greenwashed?
Well, as I say, the provability of the climate reduction is the first question that we're asking as investors. And if we can't answer that question successfully with the company, then the rest of our questions are irrelevant. So due diligence is really important as a venture capital investor. You're making long-term investments in relatively early stage companies that are doing some good things. They have obviously a level of uncertainty around how you hope to develop, that they hope to develop and how you hope to help them. But it will take some time for the tree to bear fruit. That means you really have to be a little bit relationship based and do great due diligence. So we look up and down the supply chain. We ask ourselves the question: where is this company's products made? How are they made? What are the components? Who are the suppliers? Who are the customers going to be? What are the customers doing with the product? Is there anything dodgy that they're doing with the product? And importantly, we have an external climate impact committee, which we asked to give us a level of comfort that climate effect is measurable and provable. But we also said to them, if there's something in this that you're uncomfortable with on other ESG criteria, feel free to veto it. So they have veto power over our investment decisions, which gives, I think gives our investors a level of, higher level of confidence.
Yeah. I'm assuming that if you're a equity trader, you're going to be looking at analysts' reports, right? You're going to be reading the stuff that's coming from analysts and share brokers who will be asking the questions about liability. So, no one wants to invest in a stranded asset, right? So some of these liabilities would be identified, wouldn't they, in analyst reports particularly on equities?
I'd certainly imagine so, but I mean, part of our hypothesis is that climate risk is underpriced and under not fully measured and valued. The climate risk is,
yeah,
and therefore a lot of portfolios, I believe, have got downside that they haven't fully recognised.
Can you give us a for instance, as the Americans say?
It's hard to give you a for instance without being too specific about it, but I mean, I think if you're holding a portfolio of assets that are exposed to the global economy, and you look at what's happening to the global economy and what those causes are. Just saw a video this morning from the United Nations looking at flooding events, which were in places like Mexico, Brazil, Guatemala, but also Spain and Greece, also in Asia, and horrendous flooding, of course, in Libya just the other day. So that's just one set of climate impacts that are hitting the economy. If you're in, you've got an equities-based portfolio that is exposed to the global economy is going to suffer from some real stresses because of climate response now, but projected to get worse in future. So I see that as downside, and I don't believe that a broad portfolio that hasn't thought carefully about that would have that fully factored in. Darcy, you might not agree.
Yeah, no. I'm picking up what you're laying down, and I'm just trying to understand the implication though around fees, even because to get that level of detail in the research to actually go through the supply chain and to understand what the impact is on everything, how does that translate into the net returns, right? Surely that comes with lower returns because there's more cost just to adequately research what the footprint looks like. Would that be true?
I don't think so. I mean, we've placed 5 investments so far, for example. So that's 5 pieces of due diligence that we've completed successfully, and there's been some other ones where we decided not to invest, and some where we've started but not finished. So it is a pretty bespoke process. We're not doing it, for months on end for a huge number of companies. I think you'd find that for private asset classes, if you're in private equity or venture capital, they're making a relatively low number of investment decisions. So a private equity fund might have 3 or 5 investments. A VC fund might have 10 or 20. And so you're being quite specific about that. But even then, there is a point in your due diligence where you have to say, that's enough. I've gone far enough now. I think I know enough.
Yeah. There's this term going around TCFD, which is the financial disclosures around climate risk. I really don't understand it. Can you explain it, Shannon? And would that be helpful for investors to know what the downside is going to be for a company or for a stock?
Yeah, so it's a mandatory disclosure that companies have to disclose their risks and impacts in terms of the climate. And there's also the Task Force for Nature-Related Financial Disclosures that's now coming out as well.
So, what does the acronym mean? TCFD?
Task Force on Climate-Related Financial Disclosures.
Excellent.
But it's easier to say.
And will that help create greater transparency about the downside risks for investments?
Yeah, it helps the investor because they can see what the risks are in terms of that company, but that also helps the company themselves to figure out what their risks are and how they need to change their business model to account for the risks to also their business, but then also their impact on the environment and climate as well. I think like in the future, this is just a baseline now, but in the future there'll be a lot more mandatory disclosures like that. Like the EU have just introduced one for deforestation. So they aren't importing any products that have been linked to deforestation in their supply chain. So right down to the sourcing level. Mm-hmm. And there'll be things like that coming up in the next few years that I think will really cause companies to have a look at what their impacts are throughout their supply chain.
Yeah, interesting. So if I'm an investor in say I want to be in the food seen, and I'm an investor in Nestle and Danone, or I should expect to see transparency around their exposure on deforestation, labour abuses, emissions. Is that the kind of things that are going to come out with this kind of reporting?
Yeah, and it'll come out in quite a technical report they'll put out, but they should put out a summary report that's kind of lay summary as well. But we use that stuff as well at Mindful Money to kind of look into the impacts of a company if they're involved in deforestation and things like that. So Mindful Money is a good platform to.
Are you feeling comforted, Darcy? Are you starting to get the information that you want?
I'm starting to get it. Yeah, I'm starting to get it. Well, what you're kind of saying is that indirectly, like at a really high level, we're talking about more information helps direct the flow of new capital which is coming into this space, which will lower the cost of some businesses and increase the cost of other businesses that are, let's say, more brown. So it creates an incentive to greenify. So it's an interesting way to frame it, like the more information that you can unlock by going through the supply chains and just trying to understand the impact all the way through. And then that will increase, like all this disclosure increasingly helps the market be aware of what is a green investment, what is a brown investment, what needs improvement, what doesn't. And as a business owner, that's obviously really important as well.
And where the risk is, right?
Yeah.
It's not related to the TCFD, but the government has required industries and large companies to report on to create scenarios about future climate risks. There's a brilliant report. One of the first ones off the block is about the tourism sector. And they've had to do these scenarios on a 1.5 degree warming world, a 2 degree and a 3 or a 4, I think. And those scenarios are really informative about what kind of businesses are going to go out of business. Snow, for instance, is going to be retreating. And so as an investor, you'd go, should I really be investing in a rural pay-who alpine lifts business? I'm not sure. And those scenario documents, they're terrifying and informative reading. And I think as an investor, I'm really, I feel like I'm getting some insights into, where the opportunities and certainly where the downside is.
Even just with property, like there was one thing that I read which talked about properties that are more susceptible to rising sea levels on average will be discounted by 7% over a 50-year period relative to the other properties that are equidistant to the water but not susceptible to sea level rise.
Right.
And I don't know how much the market is aware of that, but as it relates to coastal properties even, like that's a factor, right? Because that will determine what value people place on this type of real estate going forward. So
I think that's right. Rowan, you probably have noticed that in the real estate section in newspapers, there are still coastal properties that are going for, epic amounts down in Pauanui and on the Napier coastline. And you think, are you not reading anything?
One of my favourite quotes of all time is from William Gibson, the sci-fi author. He said, "The future is already here. It's just not evenly distributed."
Yeah.
And so some people are paying those huge amounts of money, but there's a gentleman in the Coromandel on the other side, on the Thames coast side, who's listed his property, which is red stickered at the moment, for $1. And he said, well, we'll see how we go. Hopefully it'll be more than $1, but the house has to be written off. I saw the photo. It's got a steep hillside behind it, very thin little sliver of land, and then you've got State Highway 25, and then you've got the Firth of Thames. It's an acutely climate exposed area. And the valuation of those properties is not going to be great going forward. But managed retreats is a really real thing. I mean, we're a relatively coastal folk here in New Zealand, and a huge proportion of us live near a waterway. It's not just about being on the coast; it's being near any kind of waterway.
Yeah.
So those consequences are going to be hefty.
Yeah, it's so interesting. And we've talked a lot about downside, and there's plenty of downside with climate change. But let's talk about some upside. Rowan, you invest in tech. What's exciting you at the moment?
Heaps of things are exciting me at the moment, Vincent. But basically, decarbonisation as a topic gives you license to look at essentially any industry and any product category, which is kind of cool. One thing I'm really excited about that we have invested in is long-duration energy storage. So it's kind of obvious that we're turning off fossil fuel energy sources like gas and oil and coal, and we're turning on more and more solar and wind power and cleaner energy sources, geothermal, biomass, and so on and so But those energy sources the cleaner ones tend to be intermittent. Sometimes they're on, sometimes they're off, and you can't necessarily control when they are and when they're not. So energy storage has a huge potential because it's going to stand between those clean energy sources, which are on sometimes and off other times, and when demand is actually there for clean electricity.
The wind doesn't always blow, the sun doesn't always shine. And
that's right.
And when they do, you want to capture it.
Yeah, and even in New Zealand where we're blessed with great hydro, so hydro is a form of energy storage because you can send it downstream when you want it. But even in New Zealand, hydro is the largest form of energy, but it's not always available. We do have droughts. And hydro in a dry season, and what do you know, there's going to be more of those with climate change. Hydro shrinks as a proportion of the energy mix. So you need more forms of energy storage. So there are lots of those out there, and we've chosen to invest in one which is in the long duration energy storage sort of side of things. So a lot of lithium-ion battery type solutions that you see being deployed in your home or in the grid somewhere are relatively short duration. So they'll help you to keep the power on for a couple of hours, maybe sort of 2, 4, maybe even 8 hours, but not for a day and certainly not for a week. And you are going to need those forms of long-term energy storage. And we think technology's got some great options there. You know, the government's talked about investing in Lake Onslow down in the South Island. But if that comes on stream, it won't be until the very late 2030s at the earliest. And if you're in New Zealand, most of us are in the upper North Island. Lake Onslow is at the far south. So you've got a long new transmission line that's going to be needed to bridge the gap between the two.
So if you were a personal investor, so we're not all venture capitalists around the table here, I'm sorry, Ryan, but if you were, a personal investor, a KiwiSaver investor, how would you take something like storage and apply it to your own thinking? And, you know, if you were into it and you thought, hey, well, that actually makes sense, that's a great opportunity, how would you begin to make some investment research or even decisions about that?
Like, I think it all starts at home, personally. Like, moving to EVs as a start, going solar as much as you can afford to. I'm fascinated about what you were saying there, though, before, Rowan, just because of the kind of learning that I've done around how you could basically set up Bitcoin mining facilities that are solar powered as a means to an end, so that you over-engineer solar generation, which then can help fund the build-out of the new infrastructure required to harvest it from one area and transmit that energy somewhere else. And I just wonder if, even at a household layer, as a proxy for a battery, you have a financial storage device, which is Bitcoin generation at a micro level by over-generating solar on roofs. I know that's a little bit out there in terms of an idea, but it's just one of the many.
No idea is a bad idea, but
yeah,
maybe that one. But,
maybe that was.
So what you're saying is using the revenue that you might generate from your Bitcoin, what's it called, mining, to fund solar and overspec the solar, so it's actually. You know,
because that helps alleviate some of the storage issues, right? Because then it's obviously going to be volatile, but if you're way overproducing during the day, then that helps. But you have to have a way to actually utilize that surplus energy, and what better way than to monetize it in the digital space, I think, anyway.
I suppose you find with personal investors that they're not professional investors, right? So there's a real kind of blurring of lifestyle and investing. So people tend to invest in the things that they like.
Yeah, well, not everyone's a business person, right? And I think to be a good investor, in a sense, you almost have to be a good business person, because it's kind of the same thing.
Right.
And so if you're not into that, then you probably rely more on the larger funds to do all the heavy lifting for you. And that's where there's a lot of trust and things like Mindful Money and other platforms like that.
Yeah.
But at a micro level, I think you have to be into business to really get into that.
Yeah. Interesting. Another topic that we haven't really talked about is the reverse of using your personal investments to actually reward and punish companies and organisations that you think are contributing or solving climate change. Can you tell us about, rather than being a beneficiary of finance, using it as a weapon or a tool for change? I imagine that some of your Mindful Money customers are doing that, right?
Yeah, I'm a big proponent of, instead of saying money makes the world go round, we should probably change it to money is an enabler of good things and bad things in the world, even though it's quite long. Maybe we shouldn't do that. But
There's an acronym for that.
yeah, probably TCFD. But yeah, like it can, as much as climate change and like all the exploitation that goes on, I'm going to name and shame some fossil fuel giants, but like BP and Shell, they are making record profits at the moment. And if you dig down into it, like they are putting most of their profits into exploration of new oil and gas, and the amount they're putting into low carbon technology or renewable energy is tiny compared to that. And so they have every opportunity to do it right now, but they're not doing it. And so I think to a certain extent, yes, we need to support the transition, but when the big players aren't playing their part, then
then you need to use your
use your power.
Use your power as a consumer and as someone with a moral voice.
Yeah, exactly. And investment in terms of what you can do with it is a spectrum. So at the red flag end, you've got the traditional stuff where you only look at the financial return. Like, is it going to make me a financial return tomorrow? Yep, good. Like, that's outdated. That's out the window. The next thing you can do is screen out harm.
Why is that outdated?
I think like you're going back to saying the long-term thinking of investment. Like for me, in 2050, when it's meant to be a completely decarbonised world, I'll still be 15 years off retirement. Like that's crazy to think about. Like why would I want fossil fuels in my KiwiSaver? Because they're not going to be around. I'm not going to be making a return for that amount of time.
Yeah.
And so just taking a longer-term thinking of like what industries are going to be hit hard with climate change, and which ones are going to be around, which ones are not going to be subject to environmental fines, government regulations, have good governance structures in place, not causing harm to communities. Like those are the kind of things that you want.
Even though Shell and BP are raking it in now, your argument is that long term they're set up for failure.
Exactly, because like if you think about them investing now into new exploration and production, they're going to face a huge cliff to fall off in the future when we are decarbonised because they haven't put any money into or enough money into renewable sources, and so they're going to have stranded assets and they're going to be declining. And if you look at the fossil fuel industry over the last 10 years, it's actually, even though we've got like a lot of chatter at the moment about them going up in profits, if you look at the last 10 years, they've actually gone down and are declining in terms of the benchmark, like compared to the S&P 500 benchmark. Fossil fuels have not historically done very well.
All right.
Yeah, some people might look at the data. It says that.
Yeah.
And so, I think just taking a longer term view and going back to that spectrum, like the next kind of equal thing you could do in terms of exclusions is engaging with companies. So, turning up to Shell or BP's AGM and saying, transition to fossil fuels. Good luck with that, but you can try it. You can engage with your KiwiSaver provider and say, hey, I've used the Mindful Money tool when I've seen that I've got fossil fuel investments in my KiwiSaver. I don't want them there. Would you consider divesting from them? And then the next best thing you could do is look at switching into more different companies, so companies that have greater environmental, social and governance things in place. And then the golden end of the spectrum is what we call impact investing, and that's like investing in things that make a positive impact. So, climate technology that's equitable, or social housing, or renewable energy systems for communities, things like that. So,
and that's where you might expect a lower return because you're aligning it with a social good or an environmental good. Is that? But
the cool thing with what you're saying though is that there's like this relationship between the returns and the underlying value of the asset, and I think that's the key with what you're saying. Like maybe investing in Exxon or BP right now, you might get good cash flow out of it. They're earning really well, but the underlying value of those assets, that's going to invert maybe over time. And then the opposite could be said with the green investments, where you're getting a discount today in terms of the earning, but potential long-term growth in the underlying asset, right? So I think it's just understanding that there's so much nuance, isn't there?
Yeah.
Exactly. And like even professional investors, they don't base an investment off what the return was yesterday and what it's compared to today. They have a whole process they go through to see, is this in a declining industry? Is this going to cause harm and have legal implications? Like there's a whole raft of things they look at. So why wouldn't personal investors look at, a wider picture as well?
Yeah. Okay. Nice one. Quite holistic. I'm
there we
liking
go.
it. Let's wrap up. I think that, it's a complex area that's nuanced. There are some new dynamics. So let's think about what kind of advice we would want to go forward. I mean, you're experts, right? Well, that's what we've sold you as. So
You've sold us as that.
Yeah.
Well,
Yeah. So let's hear from the experts. Do you have a bit of advice for people who are interested in the interface of climate change and investing. Maybe we start with you, Ron.
Yeah, I think climate is something that we're all learning about. We're all learning by doing or not doing. So taking an interest is important. And then when you take an interest, as you say, you might choose to do things locally with your own purchasing decisions around, should I put a solar array on my house, or should I buy a greener product at the supermarket? You can choose your democratic vote in just over a month's time in New Zealand, just under a month's time, to vote for a cause for a party that has got climate-friendly policies. But you can also look at your money, and I think Mindful Money is a fantastic service. They are a charity, and you should donate money to them. So that would be a really good idea, tax deductible as well, I understand. Just taking that interest, where start with your KiwiSaver if that's the right place for you, and ask those questions. What am I comfortable with? What am I exposed to? And then what are my upsides? What we do in venture capital is obviously relatively specialist. It's not for everybody, but there are big opportunities there, and would certainly be happy to talk with people about it. But it's not the mainstream, if you like. It's a relatively small subset of a bigger portfolio.
Yeah.
And the whole of your portfolio is exposed to climate, either for positive or for negative. So you do need to think about it.
Right. Be curious.
Yeah. Take an interest.
I mean, that's going to be a virtue of any personal investor, right? Be curious about the world. Shannon, what's your advice?
Probably my advice for more of the bigger picture and to KiwiSaver providers themselves is that people actually want to invest ethically. So Mindful Money does a survey every year and has a look at what the New Zealand public want. And we know that 3/4 of New Zealanders want their investments to be managed ethically, and 3/4 of people don't want fossil fuels in their investments. So there's demand for it, and you only have to look at the amount of sustainable funds and impact investing funds and impact investing KiwiSavers out there right now to know that it's a growing need and growing demand. And so I think it's always going to be there and it's going to get bigger. And then probably my advice for like personal investors themselves is don't leave it up to the fund providers or the financial industry or the politicians or the big corporates. Like, you have such power in your voice, and we're really lucky to live in a country where we have that. And you can make change with your wallet, and just by talking to people, talking to your fund provider, talking to companies that you might invest in, is like the best thing you can do. Talk to your peers, talk to everyone you know, because and look at things not only now but into the future. So there's maybe like 3 or 4 pieces of advice, but
find a voice. I think we could
find
summarise
a voice.
it. Darcy, you get the final word.
Oh, thank you. So I would say there's risk, there's reward. So sometimes those are going to be held in tension. You need to find that right blend of risk and reward within all of your investing anyway. And this climate dimension is just another manifestation of that. So you kind of have to really think deeply about that, kind of like what you're saying, Shannon. It's not like there's one answer here. It's going to be unique for everybody. So not being afraid to think extremist thoughts, like don't be an extremist, but yeah, you can think extreme thoughts. And that's really important.
Well, the contrarians make money, right?
That's exactly how you're going to do it, right? You're going to be holding these ideas in tension. So it doesn't matter if you believe that climate change is real or that you can change the climate even by the way you invest, because there's tons of money coming into it. Do you want a piece of that or not?
Right.
Right. So I think the other part is diversification between existing and new, or brown and green, like we've been kind of saying. I kind of still would stay open around that, because there's probably potential in some industries to realize this value that can be unlocked by going more green, and you kind of want to benefit of that. So if you are looking for a return and you're doing good, sometimes they will be in tension, and that's okay too. Green and brown, great fashion, right? 70s.
70s are back.
Yeah.
Well, thanks, Rowan, Shannon, Darcy, for joining this conversation. It's been really super informative. And thank you to our millions of viewers who have tuned in for this live webinar as part of the Auckland Climate Festival. So, ngā mihi nui. I hope you have a great afternoon and enjoy the rest of this sunny day, because I don't think this weather's going to last. Well, who knows? There's a changing climate.
It'll get warmer.
It'll get warmer, that's for sure. Thanks and good afternoon.
Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Guerrilla Technology, increasing business success through innovative and strategic IT solutions. And Ungaro & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.